Right now, if you're carrying a credit card balance, an auto loan, or a mortgage, you're trapped inside something the Federal Reserve calls an interest rate trap. And the data says 84% of the middle class doesn't realize it's already closing around them. In 2008, people lost their homes, but they saw it coming for months. They watched the warning signs stack up. They had time to react, even if most didn't. This time is different. The entire middle class balance sheet is under pressure simultaneously. Mortgages, credit cards, auto loans, all at once. Not one after the other. All of it at the same time. And the next phase doesn't start in 2027. It starts in the next 90 days. Most people think rates are the problem. They're not. Rates are just the trigger. The real problem is something buried deep inside your household balance sheet that you can't see yet, but that the Federal Reserve Bank of New York is watching very closely. It's not a number on a screen. It's a structural condition, a gap between what your debt was designed to cost and what it actually costs now. And that gap is widening every single month. I'm going to walk you through the exact sequence of what happens next, the specific timeline, the mechanism behind it, and why the households that understand this before it accelerates will still have choices. The ones that don't will get forced into decisions they can't take back. Decisions made under pressure, without options, at the worst possible moment. But before any of that makes sense, you need to understand one thing that almost nobody is explaining clearly right now. The difference between a recession and a structural reset. Because that difference changes everything about how you respond, what you prioritize, and how much time you actually have. A recession is cyclical. It comes, it hurts, it passes. Business slows, unemployment rises, and then the economy recovers because the underlying financial structure is still intact. People are carrying debt they can afford at the rates that exist. Asset prices might fall, but the foundation holds. A structural reset is something entirely different. A structural reset is what happens when debt has been accumulated under one financial environment, and then that environment changes in a way that makes the debt unsustainable, not temporarily painful, structurally unsustainable. That's the distinction, and that distinction is where we are right now. From 2020 through early 2022, the Federal Reserve kept interest rates near zero. Mortgage rates dropped below 3%. Credit card rates were manageable. Auto loans were affordable. The message being sent by policy was clear, even if it was never stated directly. Borrow now, the cost of money is low, and it's going to stay low. Refinance later, lock in the gains. Leverage feels like wealth when asset prices are rising, and borrowing is cheap. Millions of households believe that message, and they borrowed. A lot. Mortgage balances surged past $13 trillion. Credit card debt climbed to $1.28 trillion. Auto loans reached $1.67 trillion. In total, household debt expanded by over $4.6 trillion in just a few years. And at the time, that felt rational. Cheap money makes debt feel harmless. Rising home values make leverage feel like strategy. But that phase was never prosperity. It was stage one of the trap. It was the accumulation phase. And every trap has an accumulation phase. That's how you get people inside it. Stage two arrived with violence. Between 2022 and 2023, the Federal Reserve raised interest rates from near zero to over 5.5%, the fastest tightening cycle in 4 decades. That single policy shift repriced the entire cost of borrowing across the U.S. economy almost overnight. Mortgage rates jumped from under 3% to above 7%. Credit card rates pushed toward 20%. Auto loan rates surged to levels not seen in over a decade. And here's where it becomes concrete. A middle-class household that could comfortably afford a $1,200 monthly mortgage payment was suddenly looking at a $2,200 payment for the exact same home. Not because the home changed, not because the family's income changed, because the cost of money changed. That is the precise mechanism that separates a functioning middle class from a trapped one. Now here's where the data becomes impossible to ignore. American households are currently carrying $18.8 trillion in total debt. That number expanded by $740 billion in a single year. The overall delinquency rate has climbed to 4.8%, the highest level since 2017. And that number was recorded before the most recent inflation shock, before energy prices surged again, and before expectations for rate cuts were quietly removed from the 2026 outlook. Serious credit card delinquency has reached 12.7%. Auto loan delinquencies are climbing past 5%. Student loan defaults have jumped from under 1% to over 16% in a single year. HELOC delinquencies have more than doubled. These are not isolated data points in separate corners of the economy. They are synchronized signals arriving at the same time, across the same demographic, for the same structural reason. And the Federal Reserve Bank of New York has confirmed that these delinquencies are concentrated in lower and middle-income households. That confirmation matters, because that is exactly how every reset begins. It starts at the margins and moves inward. It starts with the households that have the least buffer. By the time it reaches the center of the income distribution, the damage at the margins is already irreversible. Now, there's an obvious question here. Why doesn't the Federal Reserve simply step in and stop this? Why not cut rates, relieve the pressure, and let households breathe? Because the Fed is trapped as well. Inflation is still above target. The OECD is projecting inflation at 4.2% for 2026, well above the Fed's 2% goal. Energy prices remain elevated. Geopolitical pressures continue adding cost across global supply chains. If the Fed cuts rates aggressively right now, it risks reigniting inflation at a moment when institutional credibility around price stability is already fragile. That's not a risk they can accept without political and economic consequences that would last years. But if the Fed holds rates high, the debt burden continues to compound for households that are already stretched beyond their capacity to absorb it. This is the policy trap layered directly on top of the household trap. And history shows very clearly what happens in this situation. Policy reacts late, not because the people running policy are incompetent, but because the data that justifies action arrives after the damage is already spreading. In the 1970s, the Fed waited too long to address inflation, then overcorrected with rate hikes so aggressive they crushed an entire generation of borrowers. In 2008, meaningful intervention came only after the credit system had already begun collapsing in ways that couldn't be contained by normal policy tools. In Japan in the 1990s, an economy carrying excessive debt hit rising rates and entered what economists call a balance sheet recession. Households stopped spending, businesses stopped investing. The economy stagnated for over 2 decades, despite every possible form of intervention. Different triggers, different geographies, same mechanism. Debt accumulated in one environment becomes unsustainable when the environment changes. And the people caught inside it don't get warned, they get surprised. This is the compression phase. And this is what almost no mainstream financial commentary is explaining with any clarity right now. Compression is what happens when household income, which was previously stable and partially directed toward discretionary spending, suddenly gets reallocated entirely toward mandatory obligations, debt servicing, fixed costs, unavoidable expenses. It sounds like a subtle shift. It doesn't feel subtle when it's your household. And at a macro level, it's the single most important signal in the entire reset cycle because it precedes everything else. Right now, American households are spending roughly 11% of their disposable income on debt servicing, but that's an average. And averages hide the structure of what's actually happening. Lower and middle income households are already well above that level, and those ratios are rising, not stabilizing. At the same time, real disposable income has already shown signs of contraction. The Federal Reserve's own data confirmed declines through late 2025. Consumer confidence dropped to recessionary levels for the first time since the 1970s. The combination of falling real income and rising fixed obligations is the exact trigger condition for compression. And compression, once it begins across millions of households simultaneously, doesn't stop on its own. When it spreads, spending behavior changes in a predictable sequence. Families cut back on travel first, then dining, then subscriptions, then discretionary retail of all kinds. Eventually, they begin delaying essential purchases, not because they choose to, because the monthly margin is gone. And when that happens across enough households at once, the effect on the broader economy is not abstract at all. Consumer spending accounts for roughly 68% of U.S. GDP. When millions of households simultaneously shift from spending to servicing debt, the entire economic engine begins to decelerate. Not suddenly, gradually, and then faster. Businesses don't experience this as a single crisis event. They experience it as a steady, persistent decline in demand that gets harder to explain every quarter. And when demand declines far enough, the second phase begins. Labor market deterioration. First as hiring freezes, then as overtime reductions, then as bonus cuts, then as layoffs. Happening not as a single headline, but in quiet, industry-by-industry waves that lag the initial compression phase by several months. This is where the feedback loop forms and locks in. As income becomes uncertain, households become more conservative. As households become more conservative, businesses generate less revenue. As revenue falls, businesses cut labor costs. As labor costs are cut, more households enter financial stress. And the loop tightens. This is not a crash dynamic. It doesn't announce itself. It's a slow compounding contraction. And once that loop is established, it accelerates on its own. There is no easy exit from where we are right now. The Federal Reserve has cut rates slightly from their peak, but not enough to restore affordability in housing, in credit cards, or in auto financing. According to JP Morgan's chief U.S. economist, there may be no additional rate cuts in 2026. The next move, if conditions don't improve, could be a rate hike in 2027. That means the middle class is currently trapped between falling real income, rising debt costs, and no meaningful policy relief. And the institutions managing private wealth at scale understand exactly what that combination produces. The data is not speculative. It's sourced from the Federal Reserve Bank of New York, from JP Morgan, from the OECD. What's missing is not the information. What's missing is the translation of that information into something households can actually act on. And this is where the separation happens. Not every household gets caught in the trap. The 84% that struggle aren't defined by their income level. They're defined by their exposure. High variable rate debt, minimal cash reserves, dependence on continued economic stability. The 16% that navigate this transition successfully operate with a different structure. They reduce exposure before the system forces them to. They eliminate variable rate debt aggressively, starting with credit cards. At 20% interest, a credit card balance isn't borrowing. It's a compounding liability eroding your household at an exponential rate every single month you carry it. They build real liquidity, not theoretical credit line access, but actual cash reserves. Because in a tightening cycle, access to credit is not guaranteed. Cash is. And they position for a 4.2% inflation environment by understanding that money sitting idle is losing value every single day, and that inflation-matched instruments are not optional strategy, they're baseline financial preservation. The reset is already in motion. The signals are visible in the data right now. Serious delinquencies rising, household spending compressing, labor market stress beginning to appear at the margins. The next 90 days don't begin the reset, they accelerate it. And the households that understand that timing now will make decisions differently from the ones that understand it in September. The difference between those two groups is not small. It's the difference between managing a transition and being forced through one with no options left. Understanding the trap is not the same as understanding what happens inside it, because the reset doesn't unfold evenly. It doesn't hit every household at the same moment. It doesn't affect every region the same way. There is a sequence, a pattern. And if you understand that pattern clearly enough, you can locate yourself inside it. You can see which phase is arriving next, how far away it is, and how much time you actually have before the pressure becomes unavoidable. That's what this part is about, the exact sequence, and what it means for the 2026 timeline specifically. There are 4 distinct phases to every interest rate-driven reset. They always happen in the same order, and in April 2026, they are already unfolding. Phase 1 is compression. Household income that was previously directed toward discretionary spending, toward travel and dining and subscriptions and retail, gets reallocated to mandatory obligations, debt servicing, fixed costs, unavoidable bills. The margin disappears. Families don't decide to do this. The math forces them to. And when millions of households hit compression simultaneously, the demand side of the economy begins contracting in ways that are quiet at first and then very loud. That compression creates phase 2, labor market deterioration. Businesses feel the demand decline as a gradual, persistent revenue loss. The first response is always the same. Freeze hiring, stop replacing people who leave, eliminate overtime, cut bonuses, and if the contraction persists, start layoffs. This doesn't happen all at once across every industry. It happens in waves, and it always lags the initial compression phase by 3 to 6 months. That lag is what creates the illusion that the labor market is holding when it's actually already beginning to crack underneath. Those layoffs and income reductions deepen compression and drive phase 3, delinquency expansion. Credit card delinquencies rise, auto loans stress, student loans default at increasing rates. And here's the mechanism most people miss. Delinquency doesn't rise in isolation. One missed payment creates pressure that cascades to other debts. A missed credit card payment becomes 2. 2 missed payments become restructuring conversations. Restructuring becomes default. And default affects the lending system itself in ways that circle back to everyone. Banks tighten standards. Credit lines get cut without warning. Approval requirements increase. The same household that had been relying on credit access to bridge short-term gaps suddenly discovers that the bridge has been removed, not because they did anything different, because the institution made a risk decision based on aggregate delinquency data, not on that specific household's history. That's when phase 4 arrives. Forced liquidation, selling assets at exactly the wrong time, taking on high-cost emergency debt to cover gaps that have become impossible to bridge any other way. Accepting refinancing terms that are unfavorable in every dimension because there are no alternatives left, making decisions under pressure that would never be made with time and options available. This is the phase where the reset stops being an economic abstraction and becomes something personal, and this is where household wealth actually gets destroyed. Not lost on paper, destroyed in the form of irreversible decisions made without leverage. Right now, in April 2026, we are in the transition between phase 1 and phase 2. The compression is visible in the data if you know where to look. Consumer spending growth has slowed sharply. Discretionary spending is declining across categories. Households are reallocating income toward fixed obligations. Real disposable income is contracting, confirmed by Federal Reserve data through late 2025. The compression is real. It's measurable. It's already happening. But the labor market hasn't fully responded yet. Layoffs are accelerating, but they're still happening quietly. Companies are announcing hiring freezes and reducing overtime in ways that don't make major headlines. Headline unemployment hasn't spiked in a way that forces public acknowledgement of what's occurring. That lag is completely normal in this cycle. It's the same lag that appeared in 2007, in 2000, and in every prior rate-driven contraction. And that lag is exactly what creates the illusion that things are still manageable, that the data is conflicting, that maybe the soft landing is still possible. It's not. The compression is already too deep and too widespread for a soft landing to remain a realistic base case. Now let's talk about housing. Because housing is where this reset will become visible to everyone at once, even to people who have been ignoring every other signal. The conventional assumption is that housing will stabilize because supply is constrained. That logic is incomplete in a way that matters. Yes, supply is constrained by the lock-in effect. Over 6 million homeowners with sub-3% mortgages are financially immobile. Selling would mean replacing a 3% loan with a 6 or 7% loan. The math on that trade doesn't work, so they stay. Inventory remains low, and low inventory is typically a price support mechanism. But demand is constrained by affordability and financing costs in a way that supply constraints can't offset indefinitely. As compression reduces household spending capacity across millions of families, fewer buyers qualify for mortgages at current rates. Fewer transactions close. Liquidity in the housing market begins to thin. And here's how housing resets in a high-rate environment, not through an immediate price collapse, but through illiquidity first. Homes sit on the market longer. Days on market increases steadily. Sellers begin making incremental price reductions that don't look alarming individually, but add up to something significant in aggregate. Builders slow new construction because the economics stop working. And in specific regions where debt stress is highest, forced selling begins. That's where actual price discovery happens. That's where the market stops pretending. The sequence is predictable and it's regional. Lower income and over-leveraged areas adjust first, then working class regions, then middle-income suburbs, then eventually prime areas begin moving. But by the time prime areas start showing stress, the narrative has already shifted publicly. The window for existing homeowners to exit gracefully is already closed, and buyers who waited for prime market correction are finding that everything has changed around them in ways that aren't favorable. The regional timeline is specific. Markets with the highest concentration of adjustable rate mortgages and peak purchase activity from 2022 and 2023 will show undeniable housing stress by mid-2026. Tampa, Phoenix, Las Vegas, Austin, parts of inland California. These are not random picks. These are the markets where the intersection of elevated purchase prices, ARM exposure, and compression-driven buyer withdrawal is creating the conditions for forced selling at scale. If you own property in those markets, that's not abstract information. If you're planning to purchase in those markets, neither is it. And if you're renting anywhere, understanding when forced selling accelerates in regional housing tells you when rental demand spikes as displaced owners need to move quickly. Now, credit cards. Because this is where the reset becomes personal fastest and where the timeline is most precise. Serious credit card delinquency is already at 12.7%. That number is high. But the more important number is the average balance carried by middle-income households, which sits around $7,400. At 20% interest, that balance generates far from $480 per year in interest charges alone. Just interest. No principal reduction, no progress toward eliminating the debt, just the cost of carrying it. And in a compression environment, when household income is being reallocated toward fixed obligations and the monthly margin has shrunk, that balance doesn't get paid down. It grows. Slowly at first, then faster. Because interest compounds, the timeline on credit card stress is the most precise in the entire reset sequence. By June 2026, credit card utilization rates will breach historical highs across middle-income households. By August, serious delinquency rates will push past 13%. By October, major banks will begin implementing credit limit reductions at scale. That move by the banks is not a consequence of the reset that happens afterward. It's a trigger for the next acceleration. Because every household that has been relying on credit availability to bridge income gaps will discover that the bridge is gone at exactly the moment when those gaps are widest. That combination is where Phase 3 locks in and Phase 4 begins. Now, the Federal Reserve. Because Fed policy is the single catalyst that determines whether this reset stays gradual or snaps into rapid acceleration. In May 2026, the Fed receives new inflation data. If inflation remains sticky above 4%, they hold rates at current levels. They signal explicitly that no cuts are coming in 2026. They may begin conditioning the market for rate increases in 2027. That's the base case. That's what the current data trajectory supports. And if that's the outcome, the message reaches every household and every business simultaneously. Rates are high, they're staying high, and relief isn't coming. That message changes behavior instantly. Households accelerate debt reduction, businesses accelerate cost cutting. The transition from phase 2 to phase 3 of the reset stops being gradual. There's a second scenario. If inflation begins falling, if energy prices decline meaningfully, if supply chain pressures ease in a way that shows up in the data, the Fed might cut rates, half a point, maybe a full point over the remainder of the year. But here's the critical detail that gets lost in the optimistic version of that scenario. Even cutting rates from 5.5% to 4.5% leaves the rate environment deeply restrictive. A 4.5% rate is still breaking household budgets. It still doesn't restore affordability in housing. It still doesn't make credit card balances manageable for households already carrying debt at 20%. The relief, even in the optimistic scenario, is not meaningful at the household level. It's a signal, not a solution. So either way, there is no relief valve. Either rates stay high and the reset accelerates on a faster timeline, or rates come down slightly and the reset continues at a slower pace, but continues nonetheless. There is no scenario over the next 90 days that produces meaningful financial relief for middle-class households carrying the debt loads they're currently carrying. That scenario closed in 2023, and it isn't reopening. So what are the households navigating this successfully doing right now in April 2026 before the acceleration phase hits? The first thing they're doing is eliminating variable rate debt, not reducing it gradually, eliminating it with ruthless prioritization. Credit cards first, adjustable rate mortgages second, any debt instrument whose cost is directly tied to rate policy and can increase without your consent. Because at 20% interest, a credit card balance is not a safety net. It is an accelerating liability that compounds against you every single month you carry it. The math on this is unambiguous. If you're carrying a 3% fixed mortgage and a 20% credit card balance simultaneously, the credit card is your actual financial priority. Not because mortgages aren't important, but because the credit card is actively destroying your monthly cash flow right now in real time at a rate that makes every other financial decision you make less effective. The second thing they're doing is building actual cash reserves, not theoretical liquidity through credit lines that can be reduced or eliminated at any time without notice. Real cash in accessible accounts. Because in the next phase of the reset, credit availability will tighten in ways that are non-negotiable. Banks will reduce limits based on portfolio risk metrics, not on your individual relationship with them. Approval standards will increase, and the households that relied on credit access to bridge unexpected gaps will find that access gone precisely when they need it most. The households that have built cash reserves won't need that bridge. They'll use reserves to cover unexpected costs. They'll use reserves to bridge income gaps if employment becomes unstable. And most importantly, they'll make decisions on their own terms rather than under the pressure of immediate necessity, which is the single most valuable financial condition that exists in a reset environment. The third thing they're doing is positioning for inflation persistence rather than deflation. In a 4.2% inflation environment, cash sitting in a zero-interest account loses purchasing power every single day, not in a way you feel immediately, in a way that compounds over time into something significant. Over 5 years at 4% inflation, that's roughly 20% of purchasing power eliminated without a single bad decision on your part. Positioning available, cash in inflation-matched instruments is not advanced strategy. It's baseline preservation, short-term treasuries, Series I bonds, inflation-protected certificates of deposit, not for return, not for growth, for the preservation of what you've already built against an inflation environment that the Fed has already acknowledged won't resolve quickly. The fourth thing they're doing is updating their assumptions about the financial environment. The pre-2022 world conditioned households to believe that low rates were the permanent baseline, that asset prices would rise indefinitely, that debt could always be refinanced into something cheaper when circumstances changed. Every one of those assumptions is now structurally false. Low rates are not normal. They were a decade-long policy experiment that ended in 2022. Indefinitely rising asset prices require the fuel of cheap leverage, which is no longer available at scale. And refinancing into something cheaper requires that rates fall below what you currently carry, which requires the Fed to cut aggressively in a 4.2% inflation environment that gives them no room to do so. The households that update those assumptions adjust their strategy accordingly, the ones that don't get caught waiting for recovery that has no mechanism to arrive. The reset doesn't hit every state simultaneously. It rolls through in sequence. States with the highest concentration of recent purchase activity, adjustable rate mortgage exposure, and compressed household budgets will feel the acceleration first. Arizona, Florida, Texas, Nevada, and parts of California. These are the markets where the lock-in effect is weakest, where the rate shock from 2022 and 2023 hit the hardest, and where forced selling will begin appearing in the data earliest. These households are already deep in phase 1. They're entering phase 2 now. States with older housing stock, lower recent purchase activity, more conservative borrowing patterns, and stronger local economies will feel this reset later. Parts of the Midwest, Southeast, and certain Northeast markets are operating with a meaningful lag. These regions won't hit phase 2 acceleration until late 2026 or early 2027 at the earliest, and that lag creates an illusion for the people living inside it. The illusion that the reset is regional, that it's someone else's problem, that there's still plenty of time. That illusion is dangerous, because the reset is national, it's rolling, and the lag isn't protection, it's just a later arrival date for the same pressure. The next 90 days contain 3 specific data events that will determine the pace and severity of what follows. By May 31st, new inflation data arrives, and the Federal Reserve communicates its policy stance in a way the market cannot misinterpret. That communication will either confirm the base case of rates held high with no 2026 cuts, or it will introduce the possibility of modest easing. Either outcome changes the behavioral calculus for millions of households and thousands of businesses simultaneously. By June 30th, second quarter earnings data begins arriving from major banks and lenders. Rising delinquency rates, tightened credit standards, reduced net interest margin guidance. That data tells the institutional market what is actually happening beneath the surface of public economic narratives. And institutional repricing based on that data is not gradual. By July 31st, labor market data for July arrives. If layoffs have accelerated in response to compressed demand, it will show in unemployment figures. If wage growth has slowed in response to business revenue pressure, it will show in earnings data. That is the moment when the market stops debating whether phase 2 is underway and begins accepting that phase 3 is approaching. Those 3 data points converge over 90 days into a single moment of clarity. Before that moment, flexibility still exists. Decisions can still be made on your terms. Variable rate debt can still be reduced at a pace you control. Cash reserves can still be built without emergency conditions forcing your hand. Assumptions can still be updated without the pressure of immediate financial crisis driving the update. After that moment, the system begins making adjustments on its own timeline, and the cost of adjusting alongside it, rather than ahead of it, is always higher than it needed to be. The 16% who navigate this successfully will have already made those adjustments before July. Their variable rate debt will be reduced or eliminated. Their cash reserves will be in place. Their financial assumptions will reflect the environment that actually exists rather than the one that existed 3 years ago. When the data arrives and the market reprices, they will already be positioned. They will be calm. They will have options. The 84% will still be waiting, still carrying high interest debt with the hope that rates fall soon, still operating with minimal reserves under the assumption that credit will always be available when needed, still expecting an asset-priced recovery that has no near-term mechanism to materialize. When the data arrives and the repricing happens, they will react. They will make decisions under pressure. They will accept unfavorable terms because time has run out. And the decisions made in that condition are not the decisions people would have made with 6 months of lead time and a clear understanding of the sequence.